IAS 2 Inventories establishes the accounting principles for measuring and valuing inventory within financial statements. Inventories are assets held for sale in the ordinary course of business, in the process of production for sale, or in the form of materials and supplies consumed during production. The standard is important because inventory valuation directly affects profitability, cost of sales, current assets, and working capital analysis. IAS 2 requires inventories to be measured at the lower of cost and net realizable value, ensuring that assets are not overstated. This approach supports prudence and faithful representation within financial reporting. Accurate inventory measurement is essential because errors in valuation can significantly distort financial performance, gross profit calculations, and the overall financial position of an organization. The cost of inventories includes all expenditures incurred in bringing inventories to their present location and condition. These costs generally consist of purchase costs, conversion costs, and other directly attributable expenditures. Purchase costs include purchase price, import duties, transport costs, and handling charges, less trade discounts and rebates. Conversion costs include direct labor and systematic allocation of production overheads incurred during manufacturing. Fixed production overheads are allocated based on normal production capacity, while variable overheads are allocated according to actual production levels. Costs unrelated to production, such as abnormal waste, administrative expenses, storage costs unrelated to production, and selling expenses, are excluded from inventory valuation and recognized immediately as expenses in profit or loss. IAS 2 permits several cost formulas for assigning costs to inventories when individual identification is impractical. The most commonly accepted methods are the first in, first out, FIFO method and the weighted average cost method. Under FIFO, inventories purchased or produced first are assumed to be sold first, leaving more recent costs in closing inventory. The weighted average method calculates an average cost for all inventory units available during the period. IAS 2 prohibits the use of the last in, first out, LIFO method because it may not represent actual inventory flows and can distort financial reporting. Selecting an appropriate cost formula is important because it affects reported profits, inventory values, taxation, and financial ratios, especially during periods of changing prices. Net realizable value, NRV, represents the estimated selling price of inventory in the ordinary course of business less estimated completion and selling costs. IAS 2 requires inventories to be written down when their cost exceeds NRV due to damage, obsolescence, declining selling prices, or increased production costs. This write-down ensures that inventories are not carried above amounts expected to be realized through sale or use. Inventory write-downs are recognized as expenses within profit or loss during the reporting period. If circumstances subsequently improve and NRV increases, previous write-downs may be reversed, but only up to the original inventory cost. This requirement supports prudence while ensuring that inventory valuations remain realistic and responsive to changing market conditions and operational circumstances. Special considerations arise when inventories are produced jointly, purchased under deferred settlement arrangements, or held by service providers. Joint production costs may require allocation between products based on relative sales values or physical output measures. When inventory purchases include extended credit terms, any financing element is separated and recognized as interest expense rather than inventory cost. Service providers may recognize inventories relating to costs incurred before associated revenue recognition. Agricultural produce harvested from biological assets is also measured initially at fair value less costs to sell under relevant IFRS requirements before becoming inventory under IAS 2. These additional considerations demonstrate the broad applicability of inventory accounting principles across diverse industries and operational environments within international financial reporting practice. Overall, IAS 2 provides a comprehensive framework for measuring and valuing inventories to ensure reliable and transparent financial reporting. By requiring inventories to be measured at the lower of cost and net realizable value, the standard prevents overstatement of assets and promotes prudent accounting practices. Proper application of cost formulas, overhead allocation methods, and impairment principles ensures that inventory values reflect economic reality and support informed decision-making by investors, creditors, and management. Inventory accounting significantly affects profitability analysis, liquidity assessment, taxation, and operational performance evaluation. For DIP IFR candidates, understanding IAS 2 is essential because inventory measurement principles are widely applicable across manufacturing, retail, distribution, and service industries operating within international financial reporting environments.